Hello everyone, this is your video on federal non-refundable tax credits.
A couple of main learning objectives here for the federal tax credits video. One is the identification and classification of your various federal non-refundable tax credits, as well as the application of those tax credits to reduce federal taxes payable for an individual. All right, here we go. So we've dealt with gross taxes payable. Now we're going to deal with net federal taxes payable. And the way we come up with that is by applying these non-refundable tax credits and deducting them from the taxes payable, the gross federal taxes payable that we've talked about previously, to determine the net federal taxes that are payable. So to continue on with my rudimentary illustrations, we'll start with our gross federal taxes payable that we saw in the last video, subtract any non-refundable tax credits that we've got, and that's going to equal the net federal taxes payable. Fairly straightforward. There's just a lot of tax credits.
Okay, here we have a listing of some of the major non-refundable federal tax credits for the current year. Some of these things you're going to see every single year that you're a resident of Canada. Some of these things are going to change from year to year. Some go away, and then sometimes we have new tax credits that are implemented by the federal budget in a new year. Please note this isn't a fully comprehensive list. Everything that's on here is definitely applicable, but there are a few credits that I didn't think were really necessary for us to get into in the course. Note that these are just the federal tax credits. Each province has their own non-refundable tax credit listing as well, and there's some overlap, so you'll have a basic personal amount tax credit in British Columbia, etc. But there's some credits for which there isn't a provincial equivalent. This course focuses, hopefully as you know it by this point, on federal tax credits and federal taxation, not provincial. Okay, we are going to start our magical tour through the world of personal tax credits by starting off with the basic personal amount. Now, the basic personal amount is a tax credit that's available to all individuals who are resident of Canada, irrespective of your income level. How it works is sort of like this. We have a base amount that is established on an annual basis, and it changes with inflation, so it's indexed to inflation every year. That base amount is then multiplied by 15%. Why 15%? As you will recall, 15% is the tax rate that is used to calculate federal taxes for the first progressive tax bracket. So if we multiply out by 15%, what we have is a credit equal to this amount for the current year. Now, this amount is not a deduction. As noted, it is a tax credit. Credit is spelled and pronounced differently from deduction, and it means a different thing. The tax credit is deducted from taxes payable, whereas a deduction that we've talked about many times in the past is deducted from actual income itself. So a credit reduces the amount of federal taxes payable that will be generated. This effectively means that for any Canadian resident earning up to this base amount during the year, if they're only earning up to and including this amount, they will ultimately have taxes generated and then offset by the amount of the credit. So a taxpayer earning under this base amount won't pay any taxes for the tax year. And that's just a start. You could potentially have additional credits on top of that, which could further reduce or increase the amount that you could earn without actually paying any taxes. So that's our first tax credit that we're going to talk about, the basic personal. We'll head on here and talk about a few more. Before we introduce any other credits though, why not do a simple example so I can illustrate how these tax credits work. So let's take an example of someone named Ryan who has 20 grand worth of taxable income, not net income, taxable income. So the question asks how much federal tax is this guy going to pay throughout the year? So what you start with is, okay, let's take a look at how much taxable income we have. Now, with $20,000 of taxable income, we're going to multiply that by the lowest federal tax bracket because $20,000 falls within tax rate, because $20,000 falls within the smallest federal tax bracket. This is going to give us gross federal tax of $3,000. And we know that we have a basic personal tax credit to apply here. So the amount of basic personal tax credit is noted for the current year right here, and this is how the calculation takes place. The credit itself is the smaller amount. It's 15% of the base amount, which gives us a final amount of net federal taxes payable, right? Net of any tax credits for the year noted right here. And that's how much tax, in the absence of any other tax credits, that Ryan is going to pay for the year. Next up in our list of credits is the spouse or common law partner credit, which we see utilized quite frequently. So this is available to individuals who support their spouse during the year. So basically it works like this. Each individual in a what the Act refers to as a spousal or common law relationship is entitled to the basic personal tax credit. The base is the same amount that we saw for the basic personal tax credit in our previous slides. That is again multiplied out by 15% for the amount of the actual credit shown right here. So what will happen is that in situations where you have a higher income earning spouse and a spouse who's not earning very much income, maybe they're staying at home and looking after children, or maybe they're just otherwise not, heavily employed, the spouse who is the higher income earning spouse will potentially get to use effectively 2 basic personal tax credits. That would be if the lower income earning spouse was not actually earning any income at all. What will happen is that the credit base itself will be reduced by any net income that the spouse earns. So if they start earning if they can earn anywhere up to the base amount and still transfer the credit, once the actual base amount is hit in terms of income earned by the lower income earning spouse, that credit is no longer transferable. It effectively gets used up on the lower income earning spouse themselves. Only in the instance where you have a lower income earning spouse who is earning less than the annual base amount is a situation where you're going to be able to transfer some of that credit. Here's an example of how that's going to work. So here's me, or sorry, someone named Ryan. He's got current year taxable income of 30 grand and his spouse has no taxable income for the year. We're quite a powerhouse couple here. How much net federal tax is Ryan himself going to pay? Well, here's how it works. I got taxable income. Ryan has taxable income of 30 grand. That gets multiplied out by our lowest federal tax rate of 15% to generate $4,500 worth of gross federal tax. Am I going to pay that much? Nope. What's going to happen is I'll apply first my basic personal tax credit, shown here, minus the spousal tax credit, which is fully usable because my spouse earned no amount of income during the year. For every dollar of income my spouse had earned, that base would have been ground down and the tax credit would have been smaller, but in this case it's not reduced at all, and I end up paying a whopping $958 worth of tax for this particular year.
Next up is the wholly dependent person tax credit, which is also called the equivalent to spouse tax credit. Works very similar to the actual married or spousal tax credit. It has the same base, same credit resulting from it, and it's reduced by that eligible dependent's net income for tax purposes. Now, who would qualify as a dependent and who would qualify to receive this credit? Well, this is available to taxpayers who are single, separated, widowed, or divorced, and they are supporting a dependent. So this is not a credit that's available to you if you are married. The dependent has to live at the taxpayer at some point during the year. The dependent has to be either a son or a daughter, a child of the taxpayer, parent, grandparent, grandchild, brother, or sister. And the dependent, if the dependent is 18 years or older, they have to be mentally or physically infirm. Right? This doesn't mean parent or grandparent. You are eligible to receive the wholly dependent person credit for a parent or grandparent if you are supporting them, as long as they're not earning a lot of net income. Now, there's only one eligible dependent person that is allowed per taxpayer. So if you have multiple people that you are taking care of, dependents as it were, you are only entitled to one of these specific eligible dependent credits.
Next up is the Canada Caregiver Tax Credit, which is a fairly common tax credit, the base of which is shown and the related credit is shown right here. So this is available to taxpayers who are caring for a child, grandchild, parent, grandparent, brother, sister, uncle, aunt, niece, nephew of themselves, right, of the taxpayer, or of their spouse. And they are caring for these individuals because they are dependent upon the taxpayer because they have some form of mental or physical infirmity. Now, that's sort of a tricky to define terminology. The way, if you read through, the Income Tax Act and, interpretation on this, it's described as that, it's a mental or physical condition that, affects or moderately interferes with the taxpayer's life, but doesn't prevent them from doing all the things they would normally do, right? Doesn't prevent them from doing it. It does affect it to an extent, though. So I'm not going to be particular about your knowing the definition of infirmity versus, say, disability. It's just something that you should probably be aware of. I would, on an exam, indicate that, a taxpayer is looking after an infirm relative. So parents or grandparents, if a taxpayer is caring for parents or grandparents, if they are above 65 years of age, they don't actually have to be mentally or physically infirm in order for the taxpayer to qualify for this credit if the taxpayer is caring for them and providing them with in-home care for their parents or grandparents. Now, the credit base here, it's a decent sized credit. It's getting up there at over $1,000. It could potentially be reduced by the dependent's net income if they were to be making net income, if that income exceeds a certain threshold. I'm not going to get into the specific details of it. There's no way I'm going to ask you to calculate that on any kind of an exam. But I just want you to be aware that this credit could ultimately be reduced to nothing if this mental or physical infirmity is not inhibiting, a taxpayer or a taxpayer's dependent from earning like a pretty sizable net income.
Next up, we have the family caregiver amount, which is actually a supplemental credit, meaning this amount that's listed here is going to be added to the base of several of our different credits. We have the spouse credit, wholly dependent person, the Canada caregiver, and it's worth noting that this can only be claimed on one specific credit, so you can't double up. If one person, for example, is eligible for the wholly dependent person credit, they cannot also get the Canada caregiver credit and have an FCA amount on top of that. Okay, so if this FCA amount, which is again a supplemental credit, it would be added to the base. If it's claimed for any individual that's 18 or older, the individual has to be dependent due to a physical or mental infirmity. This is not uncommon. This can be claimed for each infirm child under the age of 18 at the end of the year, which is interesting because there is no longer a child tax credit in Canada. But if you are looking after multiple children who are, for whatever reason, physically or mentally infirm, you do get to claim a $2,150 base tax credit for each one of those children. All right, hope that makes sense.
So the next credit that we're going to discusses the age tax credit. The age tax credit has the base listed here times 15%, which gives us our final credit of this amount listed here. It's a decent sized credit. Now the age credit is available to those resident Canadian taxpayers who are age 65 or older at the end of the taxation year. Basically, it's a credit that you get just for making it that far. The credit base is like a number of other credits that we see wherein it is reduced if the taxpayer is actually earning income. So here we see that the credit base is going to be reduced by 15% of the taxpayer's income that is in excess of the amount listed here. We also see that ultimately the tax credit is going to be reduced to zero if the taxpayer has a high enough income. So once this particular threshold is met, ultimately sort of the clawback or grind down, that's more appropriate terminology, of this credit is ground down to nothing by the time the taxpayer earns this amount of income. So it's a little complicated when we have these credits that are affected by income. So I'll try to do a demo of this in our next slide. I've mentioned a few credits that have what we called income thresholds, such as the age credit and the wholly dependent person, as well as the caregiver. So how do these income thresholds actually work when it comes to calculating our overall tax credit? So what we do is we start with the base amount before we make any reductions. So that's going to be the base amount of whatever tax credit that you're using. And that'll be supplied, of course, in any kind of an exam. So you've got your base amount, and then you are going to subtract a combination of two things. So you'll take a look at the net income, right? And then you're going to deduct that threshold that's provided, that I would definitely provide, right, which the Income Tax Act updates every year and is indexed to inflation. So you take net income, you subtract the threshold, that'll give you a sum, and that's what you're going to deduct overall from this base amount. Once you've subtracted this sum from your base amount, you're going to get your new base, and that new base will then be multiplied by 15% in order to come up with the actual amount of the tax credit. So we'll run through it with an example. If none of that made any sense, we'll run through it with an example. Here we've got Mary. She's 65 years old. She's entitled to the age credit. She has this income for the year of 54 grand. And then for the current year, the age tax credit has the income threshold that I've listed right here. So we need to figure out what the base is for her age credit for the current year. So we'll do that in the next slide. Here we go with our fun example. So we've got Mary again. Here's the narrative. She's entitled to the age credit. She must be 65 or older, and she has the income of 54 grand. So for the current year, the age tax credit has an income threshold of this amount listed here, meaning as soon as Mary starts to earn dollars in excess of that amount of income, her tax credit is going to start to be reduced. So we need to figure out the base for the age credit, and then we'll figure out what the actual credit is after that. So here's the base amount of the tax credit before we do any kind of reduction whatsoever. We are now going to subtract the sum of two things. So we've got her income and we've got the threshold for the year, which was indicated earlier. We subtract the threshold from her income, we get a net amount, and we multiply that by 15%. That gives us the amount that we see over here on our right. Once we do that, we subtract it from the base amount before the reduction to come up with the net amount. I'm just going to erase this to make sure it's a little more clear here. So we've got our net amount. That's the base for the credit for the year. In order to come up with the actual amount of the credit, you know what we need to do. We need to multiply that by the 15%, and that gives us an actual credit of the amount listed right here. Well done, everyone. You successfully calculated the age tax credit for Mary.
Next up, some fairly common credits are the CPP and EI contribution tax credits. Now, this credit base is going to be equal to whatever the taxpayer actually contributed to the Canada Pension Plan and Employment Insurance Plans throughout the year. The maximum credit base is the current year maximum for CPP and EI. So I have the current numbers for the current year listed right here. That's the maximum the credit can be, and once again you'll multiply that by 15%. Now the pension credit is another very common credit, and it's for anyone who is receiving pension income. Remember, that is considered other income in our net income for tax purposes. So the base is any pension income, dollar for dollar, that the taxpayer earns with a minimum, or sorry, maximum I should say, there you go, maximum credit base of $2 grand. That's again multiplied by 15%. So for example, if I had pension income of $1,000, then I would have a $1,000 tax credit base. I'd multiply that by 15% for a $150 tax credit. If I had pension income of $4,000, the maximum credit that I'm going to get is $2,000. Multiply that by 15%. I think that would be $300. So there's a lot of different pension income that qualifies. Any registered pension plan receipts, RRSP, RRIF, and any similar annuity payments would qualify. What doesn't qualify is Canada Pension Plan receipts and old age security receipts as well. First up is the Canada Employment Credit. The Canada Employment Credit is something that, it's a credit that everyone who actually earns employment income is entitled to. So whether you knew it or not, as long as you're earning over a very low threshold, current threshold for current year listed here, as long as you're earning over this amount, you're entitled to this specific tax credit. Again, that's the base. You times it by 15%. Now, the disability tax credit is available to taxpayers with a severe or prolonged mental or physical impairment, and that has to be certified, designated, signed off on by a medical doctor. So the credit base for the current year is listed here. There's also an additional supplement if the disabled person in question is a child under the age of 18, and that would be less. This supplement is less any relevant or eligible child care and attendant care costs. Now, the credit is generally transferred to a person, generally a parent, who is claiming that disabled person as a dependent. So the way this usually comes up is if you have a mentally or physically disabled child, they are unable to use the credit themselves in order to reduce their taxes payable, so the credit gets transferred to the parent. So it's a fairly large credit base. Therefore, usually not usually, all the time there is a doctor involved to ensure that the child in question meets or the dependent, or the potentially parent, whomever, meets the definition of prolonged mental or physical impairment. Here's one most of you will recognize. It's the tuition fee credit. Now, the credit base is whatever eligible tuition fees have been paid during the year, and that's tuition fees to any accredited university or college, etc. The tuition fees have to be post-secondary, so this doesn't qualify if it's for high school or some kind of fancy private school or something like that. If it's an institution outside of Canada, the courses have to lead to some sort of a degree, and they have to be at least 3 weeks long. And the tuition fees must be at least $100 per institution in order to qualify. So again, this is a very common credit for younger people when they're in university, when they're paying for their school, or even if their parents pay for their schooling. The credit goes to them, and then the credits can potentially be transferred. So we'll talk about the transfer very shortly. Again, this is a dollar for dollar credit, and that generates the base, and then the base is multiplied by 15%. I'm sure you guys are all familiar with this as well, which is the transfer of tuition credits, wherein tuition credits that are not needed by the student to bring their taxes payable to zero can actually be transferred to a parent, a grandparent, or a spouse. Now, the maximum transfer is $5,000 on an annual basis of that credit base, which gives you a $750 actual credit once you multiply it by 15%. Any unused tuition credits can be carried forward by the student indefinitely, which is interesting because this isn't very common amongst tax credits. You either use them in a year or you lose them, but tuition is not the same. Tuition can be carried forward indefinitely. Next up, any interest on student loans that have been paid is eligible for a tax credit. So this is for any amount of interest paid on student loans. The base is equal to the amount of interest paid. You would then multiply that by 15%, and you can actually carry this forward for up to 5 years if you don't use it in the current year, which is unusual. Again, not many tax credits are able to carry forward. The transfer of spouses' unused credits. Now, this is interesting. There are a few credits that if your spouse doesn't use them up, then they can be transferred to you as a taxpayer, as long as the spouse doesn't need those credits to bring their taxes payable down to zero. So these are the credits: the tuition credit, the pension credit, age credit, and the disability credit, all transferable to spouse if the taxpayer themselves does not need them. Next up is the popular medical expense credit. Now, the medical expense credit base is going to equal whatever qualifying medical expenses that a taxpayer incurs minus a threshold, and that's going to be the lesser of 3% of their net income, or $2,268 for the current year. Meaning if you have, for example, medical expenses of, $150, in all likelihood you're not going to exceed the threshold, and those won't be able to be claimed as a credit. Now, this is another interesting credit in that it actually includes medical expenses incurred in any 12-month period, as long as that period ends at some point during the tax year. So, for example, the year 2017, if you had medical expenses that went from June of 2016 right through to July of 2017, then that 12-month period could potentially be included, even though some of those expenses were incurred in a prior year. Very unusual for tax credits. This is the only one that I can think of off the top of my head that spans a year end like that. Now, the expenses can be pooled for one's self, their spouse, and any children under 18. So all the medical expenses would be added up and then potentially translated into this credit. Medical expenses for other dependents not listed above could also potentially be claimed. There are caveats to that, and I won't go into that in this course. Expenses for cosmetic procedures don't qualify, so any cosmetic surgery you'd be getting, like if I were to go and get Botox or something like that just to look cooler, I wouldn't be able to claim those expenses for my medical credit. However, cosmetic procedures, if you were in sort of a car accident or something like that, or you suffered a burn, etc., those would qualify. Most medical expenses that are common medical procedures that you'd have to pay for would qualify for the medical expense credit. First-time homebuyers credit, a fantastic credit. The credit base is first $5,000 of the cost of whatever eligible home you purchase in the year. So $5,000 times 15% would give you a $750 tax credit. In order to be eligible for this particular credit, the taxpayer or their spouse can't have owned a home in any of the 4 preceding tax years. Other than that, you're good to go on this credit. What about some credits that don't use a 15% base for inclusion? Well, there's a couple of them that we really care about. One's the charitable donations credit, which is another popular credit. So this is provided for contributions that are made to registered Canadian charities, and the amount of contribution eligible for the credit would be up to 75% of the taxpayer's net income. Any donations over 75% could be potentially carried forward for up to 5 years and then result in a credit in those subsequent years. Now, donations can be combined and they can be claimed on one spouse's tax return, so that's always beneficial when you can effectively income split by reducing the taxes payable of one taxpayer by combining with the spouse. So the credit is calculated as 15% on the first $200 of contributions. So what is that, 30 bucks? I think that's 30 bucks. If you calculate that out, that's your actual credit. So we do use the 15% inclusion rate here, but what happens is that contributions subsequent to that are included at 29%. Right? So any subsequent contributions would result in a larger credit using a 29% inclusion rate. And then what happens is that if a taxpayer has taxable income that is over the threshold for the highest federal tax bracket, they actually are entitled to a larger tax credit, which is a 33% inclusion rate on the base. So whatever donations you make, as long as your taxable income is above $202,800, then you will have a 33% tax credit, which you can apply against your taxes payable. All right. Just going to run through a quick example in which we are dealing with several tax credits. So we're going to have me having gross federal taxes payable of $10,824. Now, let's say I'm single, I've got no kids, my only source of income is employment income. My employer during the year withheld $9,000 in taxes and deducted the maximum CPP and EI. I also made donations during the year of $300. So the required is going to be, what's my net federal taxes payable? And what is my actual net federal taxes payable? Meaning, am I going to have to pay money? Am I going to get a refund, etc.? So let's check that out.
So let's utilize the information in this narrative to determine what Ryan's net federal taxes payable is, and then figure out if I have some kind of a refund or not. So we will start with the gross federal tax that is calculated on taxable income. So here it happens to be this amount. We are now going to deduct our non-refundable tax credits, and they are the basic personal tax credit listed here. We've got the maximum CPP credit for the year. We've got the maximum EI credit for the current year, and we've also got the maximum employment credit for the current year. Now remember, these are all the bases, right, for these particular credits. So we will add all those up, and then we'll multiply them by 15% to actually deduct them against our tax payable. So this is the amount that we get when we multiply it out by 15%. Now we need to take a look at our non-15% tax credits. So we'll take a look at the donation credit. Now the first $200 that we have of the credit is multiplied by 15%, and that'll give us 30 bucks. The next $100, so we have a total $300. The first $200 at 15%. The next $100 is going to be at 29%. It's a higher credit, so it's going to give us a higher credit overall of $29. We'll add these two things together. For a total of 59 bucks, we're going to add that 59 over here to our non-refundable 15% base tax credits. We'll add those up. We will deduct them then. Remember, credits reduce your federal taxes, so we add them up and deduct them from our federal tax, which gives us our net amount here. This is the net federal taxes payable, but don't forget that I already paid throughout the year $9,000 in source deductions. So what happens at the end of the year is I'm looking at a sweet refund from the CRA. Outstanding. Good work, guys.
Next up is the political contribution tax credit. People sometimes confuse this with charitable donations. Note that political parties are not a charity, a registered charity, so there's a different calculation of the credit. So this is a credit given for contributions to federally registered political parties or federal candidates in the year of an election. Here's how you calculate the credit. The first $400 that you contribute has actually a 75% inclusion rate, which is much, much different than the usual 15. So you get quite a decent sized credit for this. Note that politicians right? The Income Tax Act. So it's interesting that the donations to a political party would give you a high credit, but that's neither here nor there. The next $350 you donate gives you a 50% inclusion. So far, the total of your credit is $300 plus $175, and the next $525 is included at 33 1/3% for a total of $175. This is the total max credit of $750. Any contributions in excess of $1275 won't actually earn you a credit at all.
Okay, the last credit that we are going to look at is the dividend tax credit. So this is going to enhance information that we learned earlier surrounding the inclusion of dividend income as property income in the taxpayer's net income for tax purposes. So in order to compensate for that requirement to gross up dividend income, there is an offsetting tax credit that will be generated, which will help offset additional amounts of taxes that are generated. So the dividend tax credit is calculated as follows. For eligible dividends, now eligible dividends are generally dividends that are issued from what we call public companies. The dividend is calculated as 6/11 of the gross up amount. For ineligible dividends, the dividend tax credit is calculated as 8/11 of the gross up amount. So remember, we grossed up certain dividends by certain amounts back in earlier chapters on property income. So that gross up amount is what we're going to multiply out our factor here by. So we'll take a look at an example, which I'll calculate on the next slide, in which I receive an eligible dividend of $1,000 during the tax year. We have to figure out what the dividend tax credit is going to be for that inclusion.
So here's the example I'm going to use. So Ryan receives an eligible dividend of $1,000 during the tax year. What's the dividend tax credit for him? Well, remember, the dividend tax credit is, for eligible dividends, 6/11 of the gross up amount. So what's the gross up amount? Well, we'll find out in just one second. The gross up amount here is 0.38 times 1,000. That's the actual amount of the gross up, is $380, right? The grossed up credit itself that would be included in income would be $1,380, but the actual gross up amount is $380. So all we need to do now is take our $380, times it by our inclusion rate of 6/11, and that's going to give us our dividend tax credit of $270. That's all there is to it, guys, and that's all there is for this tax credit video. Shoot me an email if you have any questions.